Ladies and gentlemen, the American guy here. Silver just rebounded 8.14% in the last 24 hours, 8.14%. From the carnage we saw 2 days ago, from the 12.83% crash, from the $73.58 low, we're now at $76.58. That's a $5.77 gain. Ask is at $76.83, and it's not just silver. So here's what we know for certain. Both gold and silver are having a strong rebound day. The question is this the bottom? Is this the moment when the capitulation ends and the bull market resumes? Or is this what traders call a dead cat bounce, a temporary relief rally before the next leg down? And here's why this matters more than you think. The technical indicators are giving us mixed signals. The 14-day RSI is at 48. That's neutral. Not oversold, not overbought. Just neutral. Which means the market hasn't made up its mind yet. Silver's 50-day EMA is at $82.50. We're trading at $76.58. That means we're still below the key moving average that technical traders watch religiously. Gold is eyeing $4,900 resistance. It hit $4,050 today. That's $50 away from a major test. If it breaks above $4,900, that's bullish. If it gets rejected again like it did at $5,000 2 days ago, that's bearish. So what's driving this rebound? According to the news, it's two things: safe haven demand and rate cut expectations. Safe haven demand means investors are getting scared again. Something happened in the macro environment that made people want to buy gold and silver as protection. And rate cut expectations means the market thinks the Fed is going to lower interest rates, which is bullish for precious metals, because lower rates make non-yielding assets like gold and silver more attractive. But here's what nobody's telling you. Here's the cynical insider take that you won't hear on CNBC. This rebound might have nothing to do with fundamentals. It might be purely technical. It might be short covering. It might be algorithms detecting oversold conditions and executing pre-programmed buy orders. It might be retail traders who think they're buying the dip and are about to get destroyed when the next leg down starts. So shut up. Pay attention. And let me walk you through exactly what's happening, what the data is really saying, and most importantly, what you need to do before this market either explodes higher or collapses again. Let me start with the raw data, because we need to see exactly how strong this bounce is and whether it is sustainable. Silver is currently bid at $76.58. That's up $5.77 from yesterday. The percentage gain is 8.14%. The ask is $76.83. Per gram, we're at $2.46, up $0.99. Per kilo, $2,461.41, up $185.60. Another source shows silver at $76.50 per ounce, up 8.2%. And yet another source shows $77.12, up 7.5%. So depending on which feed you're looking at, silver is somewhere between $76.50 and $77.12, and the gain is somewhere between 7.5% and 8.2%. Gold is showing similar variability. One source says $4,050, up 3.9%. Another says $4,832, up 1.2%. The discrepancy in the percentage gain suggests these are from different time frames or different exchanges. But the overall story is clear. Both metals are bouncing. Silver is up approximately 8%. Gold is up approximately 2 to 4% depending on the source. Now, let's put this in context. 2 days ago, silver crashed 12.83% in a single day. It hit a low of $73.58. Today, we're at $76.58. That's a $3 gain from the low. That's a 4.08% gain from the absolute bottom. So yes, we're bouncing, but we're not back to where we were before the crash. Before the crash, silver was at $1.88 to $1.92. Now we're at $1.76 to $1.77. We're still down 12 to 17% from where we were just a few days ago. This is important to understand. A rebound after a crash doesn't erase the crash. It just means you're losing less than you were yesterday. The news says silver rebounded sharply on safe haven demand and rate cut expectations. Let's unpack what that actually means. Safe haven demand means investors are scared. When people get scared about the economy, about geopolitical tensions, about financial stability, they buy gold and silver. These are the assets that historically hold value when everything else is falling apart. So what are investors scared of right now? The news doesn't specify, but we can infer. Maybe it's concerns about the banking system. Maybe it's geopolitical tensions escalating somewhere in the world. Maybe it's economic data showing weakness. Maybe it's just the realization that the stock market is overvalued and due for a correction. Whatever the reason, enough investors decided to buy precious metals as insurance that it created an 8% rally in silver and a 4% rally in gold. Now, rate cut expectations. This is the other driver mentioned in the news. Rate cut expectations mean the market thinks the Federal Reserve is going to lower interest rates in the near future. Why would the Fed lower rates? Usually because the economy is weakening. If economic data shows slowing growth, rising unemployment, or financial stress, the Fed cuts rates to stimulate the economy. And why is that bullish for gold and silver? Because when interest rates go down, the opportunity cost of holding non-yielding assets goes down. If you can only earn 2% in a savings account or treasury bond, gold and silver look more attractive. But if you can earn 5% risk-free, why hold gold that pays you nothing? So the market is pricing in rate cuts, and that's lifting precious metals. But here's the cynical take. Rate cut expectations can change overnight. One strong jobs report, one higher inflation print, and suddenly the market shifts back to expecting higher rates for longer. And when that happens, gold and silver get crushed again. So betting on this rebound based on rate cut expectations is betting on the macro narrative staying consistent. And macro narratives change all the time. Let us talk about the technical indicators because this is where we can see what the market is actually doing versus what people are saying. The 14-day RSI is at 48. RSI stands for Relative Strength Index. It measures momentum. A reading above 70 is considered overbought. A reading below 30 is considered oversold. And 50 is neutral. At 48, we're neutral. Slightly on the weaker side, but not oversold. This tells us that despite the 8% rally, the market isn't overheated yet. There's room to go higher before we hit overbought conditions, but it also tells us that we're not bouncing from extreme oversold levels. When RSI is at 20 or 25, a bounce is almost guaranteed because the market is extremely oversold. But at 48, that's just normal trading. There's no technical urgency to buy here. Now, the 50-day EMA, the 50-day exponential moving average, is at $82.50 for silver. We're currently at $76.58. That means we're trading $5.92 below the 50-day EMA. In technical analysis, the 50-day EMA is a key support and resistance level. When you're trading above it, it acts as support. When you're below it, it acts as resistance. Right now, we're below it. That means we have a ceiling above us at $82.50. If silver can rally from $76.58 to above $82.50 and hold, that would be bullish. That would signal that the downtrend is over and the uptrend is resuming. But until we break above that 50-day EMA, we're still in bearish territory technically. For gold, the news says it's eyeing $4,900 resistance. But if gold gets rejected at $4,900, if it can't break through, that reinforces the bearish case. It suggests that sellers are still in control and that we're going to retest lower levels. Here's the context that everyone needs to remember. The news references that silver recently dropped from $121 peak. Let me say that again. $121, that was the high. The lifetime high, we're now at $76.58. That means from the peak to now, silver is down $44.42. That's a 36.6% decline from the all-time high. Think about that. If you bought at $121, you're down over 36%. If you bought at $100, you're down 23%. If you bought at $90, you're down 15%. This 8% rebound doesn't change that. You're still underwater. You're still in the red. You're just losing less than you were 2 days ago. And here's the harsh reality. Most retail investors bought near the top. That's how tops work. The excitement builds. The FOMO kicks in. Everyone piles in at $100, $110, $120, and then the crash comes. And those people are now sitting on massive losses. So when you see headlines saying silver rebounds sharply, understand what that really means. It means the people who bought at $120 are now down 36% instead of 40%. It's damage control. It's not recovery. For gold, the news mentions $4,800 support. So gold is also down significantly from its recent high. And this 2 to 4% bounce doesn't erase that. Let me explain what a dead cat bounce is, because this is critical to understanding whether you should be buying this rebound or avoiding it. A dead cat bounce is a temporary recovery in the price of a declining asset. The idea is that even a dead cat will bounce if it falls from a great enough height. But it's still dead. The bounce doesn't mean it came back to life. It just means physics happened. In trading terms, a dead cat bounce is a short-term rally in the middle of a longer-term downtrend. It happens because markets don't move in straight lines. After a big crash, there's always some level of buying that comes in. Maybe it's short covering, maybe it's bargain hunters, maybe it's algorithms. Whatever the reason, the price bounces. But then, after the bounce, the downtrend resumes. And everyone who bought the bounce, thinking it was the bottom, gets crushed. So how do you know if this is a dead cat bounce or a genuine reversal? You don't, not for certain. But there are clues. Clue number 1, volume. If this rebound is happening on low volume, it's probably a dead cat bounce. Low volume means there's not a lot of conviction. It means the buying is weak. But if this rebound is happening on high volume, that suggests real money is coming in. That suggests institutions are buying. That's more bullish. The news doesn't give us volume data, so we can't use that clue. Clue number 2, technical levels. If the rebound can break above key resistance levels like the 50-day EMA at $82.50 for silver or $4,900 for gold, that's bullish. That suggests the downtrend is over. But if the rebound gets rejected at those levels, that confirms the dead cat bounce theory. Clue number 3, time. Dead cat bounces are usually short-lived. They last a few hours to a few days, then the selling resumes. But genuine reversals build momentum over time. They hold gains. They make higher lows. They attract more and more buyers. Right now, we're one day into this rebound. It's too early to tell if it's sustainable. Let me talk about something that most people don't understand. Short covering. Because this rebound might not be driven by bulls buying. It might be driven by bears covering. Here's how it works. When traders are bearish on silver, they short it. They borrow silver, sell it at $1.90, and hope to buy it back at $1.70 to pocket the difference. But when the price starts going up instead of down, those shorts start losing money. At some point, the pain gets too great. The shorts have to close their positions. They have to buy back the silver they sold. And when they buy, that creates upward price pressure. This is called a short squeeze. And it can create explosive moves higher even when the underlying fundamentals haven't changed. So this 8% rally in silver might be a short squeeze. It might be shorts who sold at $1.85 to $1.90 and are now being forced to cover at $1.76 to $1.77 because they can't take the volatility anymore. If that's what this is, then the rally will end as soon as the shorts are done covering. Once they've closed their positions, the buying pressure disappears, and the price can start falling again. How do you know if it's short covering? You look for rapid, sharp moves on relatively short time frames. You look for spikes that happen quickly and then stall out. That's classic short squeeze behavior. The fact that silver rallied 8% in 24 hours suggests there might be some short covering happening. But again, without volume and positioning data, we can't confirm it. Let me tell you what I think the institutions are doing right now, because this is where retail always gets it wrong. The institutions didn't panic sell at $73.58. They were buyers at $73.58. They've been waiting for a flush like that. They wanted retail to capitulate. They wanted the weak hands to puke out their positions. And when that happened, they stepped in and accumulated. Now, at $76.58, some of those institutions are probably taking partial profits. They bought at $73 to $75. They're selling a portion at $76 to $77. They're locking in a quick 3 to 5% gain. But they're not selling everything. They're keeping core positions. Because they know the long-term fundamentals are still intact. The 678 million ounce deficit is still real. Industrial demand is still growing. Central banks are still accumulating. So they're playing both sides. They're trading around a core position, buying dips, selling rips, accumulating slowly over time. Retail, on the other hand, is doing the opposite. Retail panic sold at $73. Now they're watching the price go to $76 and kicking themselves. And they're going to FOMO back in at $78 or $80, right before the next leg down starts. This is how wealth transfers from retail to institutions. Retail sells low and buys high. Institutions buy low and sell high. It's the same game it's always been. Let's talk about risk and reward, because this is the most important part of any trading or investing decision. If you buy silver at $76.58 right now, what's your upside and what's your downside? Upside scenario, silver continues rallying. It breaks above the 50-day EMA at $82.50. It reclaims $1.90. Maybe it goes back to $100 or even $110. If that happens, and you bought at $76.58, you could make 20 to 40%. Downside scenario, this is a dead cat bounce. The rally stalls out at $78 to $80. Then the selling resumes. We retest the $73.58 low. Maybe we break below it and go to $70 or $65. If that happens, and you bought at $76.58, you could lose 10 to 15%. So the risk reward at this level is asymmetric. You have more upside potential than downside risk. But that's only true if the upside scenario plays out. The problem is that probability matters. If there's a 30% chance of the upside scenario and a 70% chance of the downside scenario, then even though the risk reward looks good, the expected value is negative. And right now, I don't know what the probabilities are. Nobody does. The market hasn't given us enough information yet. That's why dollar cost averaging makes sense. Don't bet everything on this being the bottom. Buy a little at $76. If it drops to $72, buy a little more. If it drops to $68, buy even more. Spread your risk over multiple price levels. let's go deeper on the rate cut narrative because this is critical to understanding how fragile this rebound is. The market is currently pricing in rate cuts. That means bond traders, options traders, and economists are looking at the data and concluding that the Fed is going to lower rates in the coming months. Why? Probably because economic data is showing weakness, maybe unemployment is ticking up, maybe consumer spending is slowing, maybe inflation is moderating. Whatever the reason, the narrative is that the Fed is going to shift from hiking rates or holding rates steady to cutting rates. And that narrative is bullish for gold and silver because lower rates make these assets more attractive relative to bonds and savings accounts. But here's the problem. Narratives change fast. One strong jobs report comes out, one inflation spike, one hawkish comment from a Fed official, and suddenly the narrative flips. The market goes from pricing in rate cuts to pricing in higher rates for longer. And when that happens, gold and silver get crushed. We've seen this before. In 2023, the market kept pricing in rate cuts. The Fed is going to pivot. They're going to cut rates soon. And every time that narrative took hold, gold and silver rallied. But then the Fed would push back. They'd say, no, rates are staying high. And precious metals would crash again. So betting on this rebound purely because of rate cut expectations is betting that the Fed is actually going to cut and that the economic data is going to support that narrative and that nothing happens geopolitically or economically to change the story. That's a lot of assumptions, and any one of them can break. All right, let's get to the action plan. What do you actually do based on where you are right now? If you're holding physical silver or gold from before the crash, you hold. Nothing has changed fundamentally. This rebound doesn't mean you were right. This crash doesn't mean you were wrong. Physical precious metals are a long-term hold, 3 to 5 years minimum, so ignore the noise and hold. If you panic sold at $1.73 to $1.75, don't chase this rebound. I know it's tempting. I know you're kicking yourself. But if you buy back now at $1.76 to $1.77, you're essentially locking in your loss and then immediately taking on new risk. If this is a dead cat bounce and we go back to $1.70, you'll have sold low and bought high. The worst possible combination. Be patient. Wait for confirmation that the bottom is actually in. If you're thinking about buying for the first time, or if you're looking to add to existing positions, dollar cost average, buy a small amount now at $1.76. And set limit orders to buy more at $1.72, $1.68, $1.64. That way, if this rally continues, you have some exposure. But if it fails, you get to buy more at better prices. If you're trading this with leverage, you should have tight stops. If you went long at $1.74 and silver is now at $1.76, you're up about 2.7%. Consider taking partial profits. Move your stop to break even. Protect your gains. Don't let a winner turn into a loser because you got greedy. And for everyone, the most important thing is to manage your emotions. Don't let one green day make you think the crisis is over. Don't let FOMO drive your decisions. Stay disciplined. Stick to your plan. And remember that volatility goes both ways. Let's talk about gold specifically because what happens at $4,900 is going to give us a lot of information about where this market is headed. Gold is currently around $4,832 to $4,850. The news says it's eyeing $4,900 resistance. That's $1.50 to $1.68 away depending on which price you're using. If gold can rally from here to above $4,900 and hold, that's a major bullish signal. It means the rejection at $5,000 earlier this week was just a pause, not the end of the rally. It means buyers are still in control, and it means we're probably heading back toward $5,000 and potentially breaking through this time. But if gold rallies to $4,900 and gets rejected, that's a major bearish signal. And here's why gold matters for silver. The two metals are correlated. When gold goes up, silver usually goes up more. When gold goes down, silver usually goes down more. Silver is more volatile. It has more leverage to gold's moves. So if gold breaks above $4,900, silver is probably going to rally hard. Maybe to $1.85, maybe to $1.90, maybe higher. But if gold gets rejected at $4,900, silver is probably going to crash again. Maybe back to $1.73, maybe to $1.70, maybe to $1.65. So watch gold at $4,900. That's the key level. That's where we're going to learn whether this rebound is real or fake. All right, let's wrap this up. After analyzing all the data, what's the verdict? This rebound is real in the sense that the price is actually going up. Silver is up 8%, gold is up 2 to 4%. Those are facts. But is this the bottom? Is the downtrend over? Is it safe to buy aggressively? I don't know, and neither does anyone else. What I do know is this. We're still below key technical levels. The 50-day EMA for silver is at $82.50. We're at $76.58. We're still in bearish territory until we break above that. The fundamentals are mixed. Safe haven demand and rate cut expectations are bullish. But the $1.21 to $1.76 crash suggests there was way too much speculation and leverage in this market. And until that's fully cleaned out, we're vulnerable to more downside. The institutional behavior suggests they're buying dips and selling rips. They're trading around core positions. They're not panicking, but they're also not going all in. So here's what I think you should do. If you believe in the long-term thesis for precious metals, the deficit, the industrial demand, the central bank buying, the currency debasement, then use this volatility to accumulate slowly. Dollar cost average. Build positions over time. Don't try to time the exact bottom. If you're a trader, respect the volatility. Use stops. Take profits. Don't overstay your welcome. The market can turn on a dime. And if you're on the sidelines trying to decide whether to get in, wait for confirmation. Wait for silver to break above $82.50. Wait for gold to break above $4900. Don't buy the bounce, buy the breakout. Because hope is not a strategy. Wishing for the bottom to be in doesn't make it so. The market doesn't care what you want. It only cares about supply and demand, about buyers and sellers, about fear and greed. And right now, the market is telling us it's still scared, it's still uncertain, it's still volatile, so trade accordingly. This is the American Guy. It's Friday, February 7th, 2026. Silver rebounded 8.14% in the last 24 hours, up $5.77 to $76.58. Gold is up 2 to 4%, depending on the source. The rally is being driven by safe haven demand and rate cut expectations. But the technical picture is mixed. The 14-day RSI is at 48, neutral. The 50-day EMA for silver is at $82.50, above current prices. Gold is eyeing $4,900 resistance. We're down 36% from the $121 peak in silver. This rebound doesn't erase that. It just means you're losing less than you were 2 days ago. Is this the bottom? Is the downtrend over? I don't know. What I do know is that dead cat bounces are real. Short covering rallies are real. And not every green day means the crisis is over. So stay disciplined. Don't let one bounce make you reckless. Don't chase. Don't FOMO. Dollar cost average if you're accumulating. Use stops if you're trading. And wait for confirmation if you're on the sidelines. The market will tell you when the bottom is actually in. And when it does, it won't be subtle. You'll see sustained buying. You'll see technical levels breaking. You'll see momentum building over days and weeks, not just hours. Until then, manage your risk, preserve your capital, and don't let your emotions drive your decisions. They can't print silver, they can't print gold, but they can shake you out of both if you're not careful. This is the American Guy. Hold the line.